Welcome to the Explainer. Have you ever looked at a financial chart and just wondered if it's all random or if there's some kind of hidden logic to it all? Well, today we're going to pull back the curtain on a hugely popular trading theory called smart money concepts. It's this idea that the market's biggest players actually leave clues behind, a kind of secret code for those who know how to read it. I mean, you've seen it online, right? The Lambos, the crazy profits, but the hard reality for most everyday traders is, well, it's a lot of frustration and losing money. So what gives? What is the huge disconnect? Why is it that over 90% of people who get into trading just can't seem to find consistent success? This quote from the trading channel Smart Risk really gets to the very heart of the smart money philosophy. It completely reframes how you look at the market. See, it's not about wealth getting destroyed in a crash. It's about it getting transferred. For every single person who panics and sells, there's someone else on the other side, prepared, ready to buy. And that idea is absolutely central to this whole strategy. Okay, so let's start with how most of us are taught to trade. You read the books, you take the online courses, and they all teach you to spot these classic chart patterns, these little setups that are supposed to tell you exactly where the market is going to go next. And this right here illustrates the trap perfectly. You see a classic double bottom, textbook stuff, right? Retail logic says, okay, that's a strong buy signal. So you place your order to go long and you put your stop loss right below that support level just to be safe. But then, the painful part, how many times have you seen the price dip just low enough to hit all those stops before it rips higher without you? Well, according to this theory, that isn't just bad luck. It's by design. So that leads us to the big question, doesn't it? If we, the retail traders, are getting caught in these traps, who's on the other side? Who's setting them? And this is where the theory introduces the whole concept of smart money. Smart money is basically the name for the giants of the market. We're talking about the big banks, the hedge funds, the major institutions. Now here's the thing. Their orders are so massive, they can't just click buy or sell like we do. If they did, it would instantly move the price against them and show their hand. They have to be way more strategic to get their trades filled. So what is that strategy? What's their secret? Well, according to this entire theory, it's all built around the hunt for one single, absolutely vital thing: liquidity. Just think of liquidity as the market's fuel. If a huge institution wants to fill a billion-dollar buy order without sending the price to the moon, they need to find $1 billion worth of sell orders at the price they want to buy at. So the question is, where in the world do they find a huge pile of sellers all grouped together like that? Well, they find it in the most obvious places, right where all the retail traders are told to put their protective stop-loss orders. Remember those stops sitting right below that double bottom? Every single one of them is a pending sell order. Now multiply that by thousands and thousands of traders, and suddenly you've got this massive pool of sell-side liquidity. It's the perfect fuel for a big institution to quietly fill up their buy orders. Okay, so if these big institutions are engineering these moves to grab all this liquidity, do they leave any evidence behind? Well, people who follow smart money concepts say yes, absolutely. They believe that these institutions leave behind footprints on the chart that can actually signal what they're up to. One of the most famous of these footprints is something called an order block. This is usually the very last down candle you see right before a huge move up, or the last up candle before a big drop. The idea here is that this isn't just some random candle. Now, it's a specific zone where institutions were strategically placing huge orders, basically absorbing all the selling before they launch the real move. And that's why price has this funny habit of coming back to test that exact area later on. Another really key footprint is called a fair value gap. This happens when price moves so fast and so hard in one direction that it leaves behind an imbalance. It's like it's skipped a few price levels on the way up or down. You can think of it as an inefficiency in the market. And the theory suggests that the market's algorithm will often drive price back into that gap to rebalance the books, which gives traders a really high probability target. All right, so you've got these concepts: liquidity, order blocks, fair value gaps. How do you actually put them all together into a real strategy? Let's walk through what a lot of people would call a simplified but A-plus trading model using these ideas. So here's how it all clicks together. Step one, you find a clear pool of liquidity, like all those stop losses sitting just below an obvious low. Step two, and this is probably the most important part, you wait. You wait for the price to sweep below that level and grab all that liquidity. Step 3, you need confirmation. You're looking for a powerful reversal that actually breaks the recent market structure. And then finally, step 4, you don't chase the price. You stay patient and you wait for it to pull back to one of those institutional footprints, like an order block or a fair value gap. And that is where you plan your entry. See, what this is all about is a huge shift in thinking. You're moving away from trying to guess what the market will do based on static patterns, and instead, you're learning to react to what you believe the market's biggest players are doing. The goal is to ride the wave with the whale, not get crushed by it. So in the end, whether you see smart money concepts as this incredible revelation of how the market really works, or you just see it as a really sophisticated way to manage risk and find high probability setups, it forces every single trader to ask a much, much deeper question. Who's on the other side of my trade, and what do they know that I don't?